Hey there, Dale.
Hey, how you doing?
I am doing just peachy. It's a pretty bland, mundane Tuesday, which is a great change for once.
Bland is not bad.
Yeah,
Okay?
and hopefully your Tuesday's going well. Yeah.
Yeah, things are going well.
Well, then tell us a little bit about why mundane is the case, even though we're seeing a drop in rates again.
Well, the reality is the market has been reasonably flat. Rates are dropping a little bit. We think they're about as low as they're going to go for the time being, unless the Fed does something crazy. But we're not having these wild swings in the market right now. And that is a good thing. So,
Right. Okay, so you said something interesting in there. Unless the Fed does something crazy. Well, they're going to lower rates in September, so we should be seeing rates come down again, right?
that would be incorrect. So,
Uh,
as we talked about last week, and as you know, lenders hedge. That's what hedging is. They have a 30-day look forward to see what's going on. They know that if you get an escrow today, it's going to be 30 days before we close. So they're pricing loans today at 30 days from now rates. So they won't really get lower if the Fed lowers the rates. That's why we think they're about as low as they're going to be, unless, of course, the Fed does something crazy.
Right. So there's really only two options that currently stand in the market when the Fed lowers the rates. One, nothing, because it's already priced in the market. And conveniently, everyone thinks the Fed is going to lower it by a quarter, and interest rates dropped about a quarter in the last 3.5 weeks. So
Yep.
it makes sense. In addition to that, the other option is that rates can actually go up a tiny bit. Dale, I don't understand. It's happened in the past. Explain why is it that the Fed will lower rates, but then mortgage rates will go up simultaneously?
Well, that's because depending upon how much the Feds lower rates, lenders may be too generous right now. They lower rates and lenders go, oh, crud, we made our rates too good. Now, no, we're not even competitive. We're giving away the store. So they raise them up a little bit to compensate for that.
Right. So those are the two main big ones that you should keep your eye on. And I'll zoom through this next one. The third option, maybe even the fourth, is the Fed goes crazy and they raise interest rates. There is absolutely nothing on the horizon to influence that. If that happens, then everything's out the window. Rates are going up. If they lower rates beyond 0.25%, then yeah, we could see rates come down even further. But again, there's not really any grumblings of that. So it's kind of out of the window. And to make matters a little bit more towards the mundane side, we can see here on the mortgage-backed securities chart, there really is not much motion. We've had some slight up and down in the past, couple weeks, but truth be told, when the Japanese candlesticks start to shrink, as you see right here, especially compared to times before, it just means that the market is stabilizing, and that's just where we're landing.
Yeah,
So
that's exactly correct.
Right. So with that, we want to give you guys a tool to have in your back pocket: asset depletion loans. Dale, give us a quick rundown on asset depletion.
Quick version, you're short on income to close. You don't quite qualify. Lenders have formulas that they use that we can discuss individually, but really what they do is they take how much money you have, divide it by the length of the loan, and then they can say, well, perfect example, you have $360,000. It's a 360-month loan. We'll give you $1,000 a month credit on income.
Roughly
That's
speaking.
the short version.
Roughly, yeah. There are some adjustments that have to be made on the type of account, and there's a 10% penalty, typically speaking, if you're not of retirement age. There's a lot that goes into it. As you mentioned, talk with a professional. Obviously, we would like it to be us here at Homestead, but the idea is there. They have assets. Well, what if they were to draw those assets throughout the length of the term? They have more than enough money to buy this house cash. They just don't want to do that. So we can do asset depletion. Now, let's say asset depletion doesn't quite get you all the way there. There's another thing called asset distribution. You do need a letter from a financial advisor. There are a couple other things that we'll go into. We'll kind of keep that close to the chest because it's going to take too much time. But the simple thing is, you have money in an account, you are going to ask your financial advisor for a draw on that account, maybe $5,000, $7,000, $10,000 a month, and that's your income. This works extremely well for people who are retired, people who need to supplement their income, and it could mean the difference of a few percentage points on debt to income ratios and qualifying for the loan.
Yep. Yeah. It's a great tool.
It seriously is. It has gotten a few clients homes that they didn't think they would get. So, Dale, thank you so much for the wisdom today. Hope you have a good one.
Have a great day.
All right, you too. Bye.
Bye now.